We are back for the 2025 Master Trader Program, sponsored by Market Surge and brought to you by Minervini Private Access and Minervini Markets 360. Again, I will type into the chat box the email address to send questions with the page numbers to workshop@minervini.com. That is one word, workshop@minervini.com. We have about somewhere around an hour left in today's session, which will cover the last part of the curriculum, that being mind-blowing math as well as mindset. Remember, tomorrow, 8:30 a.m. New York time start with the same Zoom credentials for the live trading day, where we will have time for uh, Mark's screening and daily process. We'll pick up those pages that we did not cover today, as well as question and answer sessions and all the trading and activity screening and so forth that you'll get to experience tomorrow. The replay of today's session will be at 6 p.m. New York time, Eastern time here this evening. And again, same credentials for the login. With that said, Mark, take it away.
Okay, we're back. 2025 Master Trader Program, day 4. Covered quite a bit. We're on mind-blowing math now, which I assure you is mind-blowing. That's why it's called mind-blowing math. We're going to go over some more. I'm sure your eyes are opened a lot wider as far as risk is concerned. Now I want to talk about getting big returns in the market. Obviously that's why you're all here. You're all here to get big returns. You're learning that big part of that is managing the risk. Notice how, we never talked about holding, finding the next Amazon, and um, now there's nothing wrong. I always say, look, I'm not opposed to holding stocks. I'm opposed to holding losses. If you're at a gain, you buy from a volatility contraction pattern, the stock breaks out, you want to move your stop up to break even and put it away for the rest of your life. That's fine with me. Okay, that's your choice, your prerogative. If I had did that on any number of some of the stocks in the 90s, and whether it was Cisco Systems or Amazon, I probably could have just as much money or maybe even more, maybe even be a lot richer. So there's a number of ways to get there. It would have taken some really big pullbacks though and some big volatility. And that's just not what I'm willing to go through. I want to be consistent year after year. I've come up with a method to do this where it's pretty painless and very systematic. But I wanted to get you to understand this whole last section is understanding risk, just like understanding supply demand and understanding the nature of price movement. I want you to understand risk and now to understand the power of compounding in small numbers and how it actually works with trading, because there's a lot of things that we overcomplicate, and it turns out it's a lot easier than you think. Certainly a lot simpler. This stuff's not easy. It gets easy over time, but it can be simple. So every year I say the same thing. I have this this example here, these next 2 slides, and it's not probably the greatest way to exhibit this, but it's the way that I've come up with and haven't improved upon the way. But I want you to look at each of these little dots as a stock trade, with the green dot being a gain and the red dot being a loss. Now, regardless of what these gains are, they average, we could just say the gains are 12.5% and the losses are 6.25%. Just think of them as each green dot is a 12.5% profit. Each red dot is a 6.25% loss. But the same numbers would work even if they were all scattered and were different, but they average that. If the gains average 12.5 and average 6.2.5 in the loss, the same number, the same return would would result. So in this scenario here, these are the trades, right? There's 124 trades. There's 50% of them, 50% of the 122, 62 of these dots are red, all right? And 62 are green. So they're 50-50. Now, we're going to assume that each of these trades um, are 25% exposure. And they're done in chronological order, meaning that they're one at a time. So if I told you that you're going to make a trade, a 25% exposure trade, and then you can't make another trade until you sell that stock. And then 50% of them are going to give you 12%, 12.5% gains. 50 are going to give you 6.25% losses, and you're going to sell at those points. You would have 75% cash at all times. You would never be more than 25% invested. So assuming you did that, and this is the way that it laid out, these were the numbers: 124 trades, 62 of them profitable, 62 of them negative. You took gains at 12.5. This would compound to a total return of 96.5%. Now, let's say that a more real life situation, I shouldn't say more real life, that could be real life, but I think more realistic of what most people would do is that you buy the stocks as they present themselves, and you've got still got 75% cash. So if more than one stock presents itself, you buy that one too until you're fully invested, and you just roll those over. Fully invested, you will roll over in a manner of that you normally would do, but you are still trading the exact same. The trades are the same trades. Okay, nothing has changed. These are the same trades with the same gains, the same numbers. Everything is the same. The only difference is now is that you go to 100% exposure, right? So you now can go and get yourself fully exposed as those trades present themselves, and then roll into the next trades. So the first example is you're always 75% cash. You never ever go more than 25%. The next example is you go up to 100% every time there's 4 trades that are available, you go to 100%. So let's just say we could even assume that they all present themselves at the same time, and you do 4 trades and then 4 trades and 4 trades and 4 trades, and you're 100% invested every time. Let's assume that. So what's your total return now? Is it the same? Is it less? Is it more? How much more is it? Where are we now with total return? We'll give you guys a chance to think about that for a few seconds. You're more than welcome to type it into the chat box if you want. It's more rhetorical, but so your total return is exactly the same. It's 96.5%. Nothing has changed. So the moral of this story is, if you drive from Connecticut to California, it's going to take the same amount of gas, whether you stop and go or you drive straight through. If you have an edge, you're a 2-to-1 trader, you have an edge, and 50% of your gains are 12.5, 50 or 6.25, it doesn't matter whether you do them consecutively, and the 25% exposure is 25% exposure by itself, or if you do them collectively, it doesn't, either way, it doesn't matter. So getting fully invested and having this rush to get your chips into the market, because it's so funny. People don't worry about the risk so much, but they can't wait to throw that money in there. I forget who said it. I think it was Peter Lynch or somebody said people will do more research on buying an $800 TV than they will on a $100,000 stock investment. They'll buy a stock because they saw some guy pop up on CNBC and go plop 50 or 100 grand down and then hold the thing down. It's down 15, 20% and hope and pray. right? But then do 3 months of research on buying a TV to save a few $100. So, b I find that investors are so infatuated with getting fully invested, and there's this notion that, if you're not invested, you're taking this risk of missing opportunity. You have to be fully invested. The market only makes its gain. If you miss the top 12 days out of the year, you miss the whole return. There couldn't be any but more bunch of malarkey horse shit that you could ever be sold. All right. Getting in fully invested has nothing to do with it. As a matter of fact, if I can do enough trades, if my numbers supported it, I could be 95% cash and take 5% positions. Now let's just say my average gain was 20%, my average loss was 5, and it was going to take me, I don't know, 400 trades at 5% exposure. All I have to do is get 400 trades done in the time allotted, and I will get that same return as if I was fully invested.
Golden nugget.
Never being more than 5% invested, as long as I get those trades off. Now now you the question is can I get all these trades? Am I losing opportunity because I'm waiting? I got one trade on, and now this trade presents itself at the same time, and then I miss that opportunity. That's a whole different conversation. That's a different conversation. But let's say we can find 124 trades that give us these numbers back to back chronologically in a year, over a year. Well, then I double my account. I double my account and I'm never more than 25% invested. And if the numbers support it and I only had to be 5% invested, I double my account and I'm never more than 5% invested. It's that simple. I'm going to skip this slide for now. We'll come back to it later. So this is the power of small numbers, okay, and compounding. And what you need to be concerned with is the risk reward relationship and turning it over. See, if you can maintain the integrity of that risk reward relationship, it's all it is just about turnover and how many times it takes. And you can figure that out. You can go in and mathematically figure out how many trades you need and if it's realistic or not. Now, again, if our average gain is we have a $100,000 account and our average gain is $100 and our average loss is $98. Well, obviously, to make 100 grand, I'd have to do 50,000 trades or something. That's not going to happen, right? So this answers a lot of questions. When we back into these equations, it really answers a lot of questions. Well, our strategy is designed so this works. These numbers work because we know how many trades generally present themselves in a year, and small numbers work for us. So why would I try to go and find the next Amazon, which is one in a million, and I got to wait 20 years for it to happen and go through bear markets when I can simply do something where there's trades every day. Every day I'm going to find stocks that go up 10%, 5%, 20% every month, many more. That's opportunity cost, right? I made this decision a long time ago that I want to get to my goal and I want to find the easiest, most sure way to get to my goal and I want trading to be fun and exciting and not where I'm going through big drawdowns and quite frankly, and Mark, we talked about this before. You 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 know how many people out there actually held Amazon for an 80,000% move or any of these stocks? All right. You went through first, you went through a 50% decline, then a 90%, then it went up, went to new highs, you went to another 50%. The and again, and even if you did, well, now you're up 80,000%. You go through another 60% decline, you gave back 50,000%. I mean, like, which decline is the real decline? When are you actually going to sell? If you didn't sell after that, when are you going to sell? So it's so unrealistic that somebody's even that's ever going to come to fruition. It's all hindsight, looking at the biggest winning stock. Oh, we're looking at 10 stocks out of 10,000 over a 20-year period, assuming that you would have been one of those people. Again, we're going back to the lotto situation. It's just nonsense. It's absolute nonsense. This is real. This is doable. This is real, and this works. So I want to
And
show
by the
you.
way, I just want to add, Mark, you glossed over a bunch of really, really important things, but uh, this is how people who've been successful at this think. And this whole point of the mind-blowing math is to get you off of all that stuff you've been hearing. You got to be in the market all the time. It's nonsense. And anyone who says
Not
that,
what's important.
their results are terrible. I've never met someone who said you got to be in the market all the time who's had good results. Never.
Who's in the market all the time. I mean, they'll have maybe decent results. So, S&P 500 results, or maybe a little bit better.
Well, I don't consider those
Then
good.
then we point to Warren Buffett, always sends back to Warren Buffett, buy and hold. He's done 19% a year. That's great. Don't get me wrong. That's a pretty big number, especially if you're managing bill. In the last 10 or 20 years, though, he's done terrible. But let's just take his long-term track record. I'm not in the market for 20% a year. That's not what I'm here for. I'm minimum. I've compounded at over 40% a year long term, and I've had periods where I've averaged 200. I'm looking for 100% a year. And when things are going really well, I want triple-digit returns a number of years. So maybe
And Buffett, I think, correct me if I'm wrong, Mark, he's been cut in half 4 or 5 times as well.
Oh, huge drawdowns, huge drawdowns.
Huge drawdowns.
Yeah, but nothing against Buffett. Buffett's a genius. Buffett's awesome. He's he's an investment god. I'm not going to take that away from him. Bill Miller's an amazing value investor, but still returns 17, 18, 19%, right? And going through big drawdowns to get to that. I've had 3 drawdowns and 3 down years in 35 years, and they're all single digits. So, and my returns are way bigger. Well, how come I'm not a billionaire like them? Because I don't invest other people's money and get fees. So, but I mean, these hedge fund managers, Stevie Cohen's in the same book with me. He owns the Mets. He's a billionaire. Well, yeah, when you manage 10 billion like Soros, yeah, you make a lot at 1 in 20. So I manage my own money. I started with $2,000, so I only made 100 million. So, but again, most of you here, I think if I was able to even make you 10 or 20 million, you'd be pretty happy. I was a poor kid, and I just wanted to be financially independent. That's
Well,
all.
I think you're making a really good point though, Mark, about how
Yeah.
like Mark is giving you the ability to massively level up in life,
Yeah, absolutely.
as what he's saying.
That's what it was all about with me. But my original goal in trading was to make $500 a week. That was my long-term goal. My long-term goal. Because when I started, I mean, if you made 100 grand a year, that was big money. It's like doctors, lawyers made 100 grand a year. I was like, if I could make $25,000-$30,000 a year trading, wow, that would be incredible. That was my big goal. So
I'd say you outperformed that one a little bit.
yeah, I never dreamt of making $10 million, $20 million, $50 million. That didn't come till later where I said, "Oh, wow, this could work." This is when I started growing the money, but it just happened incrementally. I want to show you something here. We haven't got to the mind-blowing math. This is the mind-blowing math next. It's called the road to triple digits. So I want to show you something. And I'm not saying that this has to necessarily be the strategy. I just want you to see the numbers, and I want you to understand that a lot of what you've been told and what you believe is completely not true. And the road to triple digit returns is not nearly as hard as you think if you do the right thing and you manage the risk properly. Um, okay, so these are the rules that we're going to apply going forward in the next math equations. We're never going to take more than a 25% position size, which means we're going to maintain 75% cash at all times. Basically, what happened here. Okay. The winners are always going to be taken at 8%, or they're going to average 8%. Either one, it doesn't matter. But for argument's sake, we're going to say they're taken at 8%. The rest of the time, okay, you're going to break even, okay, or you're going to be in cash. Either one would be the same. If you're in cash, you're even, right? There's nothing gained, there's nothing lost. So it could be cash, or it could be whatever trades you did during that time. They ended up a net wash. So your goal is to wash. The goal is to net wash in the bad times, and to take the 8% profits, right? So let me show you. This will come along as we go through this. So there's 253 days of trading in the year, I believe, right? Is it 253? Remember 253? So out of that, okay, this first equation is what I'm going to ask of you to perform is to make an 8% gain. Find 37 stocks, whether they're on 37 days or not. We're calling it 37 days out of the 253. So we're going to basically make profits of 8% on 37 days. 8% gain on a 25% position, which is 14.36% of the time. It's 216 days. I'm allowing you to break even or be in cash. Either one. You can stay in cash for 216 days out of the year, or you can trade your brains out, is whatever you want to do, and just break even. Whatever you do, just break even on those days. And all I want you to do is on 37 of those days to make 8% on a 25% position. You make 107%. You think you can go out and find 37 stock trades in a year that you make 8% on? And then on everything else, just break even. Just don't lose money. Be in cash, whatever it takes. Okay, let's say we'll make it even a little bit easier. 27 days, 70%. We'll make it a bit easier. 17 days, only 7.8% of the time. Out of 253 days, you could be in cash for 236 days. Just 17 days out of that whole year, you got to find a stock that goes up 8% on a 25%. Now, remember, you're in 75% cash. You're never ever more than 25% invested. You're taking these trades, never more than 25% invested. Here's the math. How many stocks can you find that go up 8% in a period where you break even the rest of the time? Well, if you can find 13, you make 30%. If you can find 17, you make 40%. If you find 27, you make 70%. If you find 37, you make 100%. Never ever dipping into your 75% cash. If that doesn't blow you away, I don't know what will. I really don't. Because once I understood this, I said, holy cow, I could double my money on a regular basis. I can absolutely double my money on a regular basis. Maybe not every year, but I know I can have a lot of years. And I've had lots and lots and lots of years of doubling my money. And this is how I made my money. This is how I made my money. I'm going to jump forward here just a minute and go to page number 5551. So how often do you find a stock that goes up 100%? Right? How often do you own a stock and trade a stock and buy it and sell it and make 100%? Not that often, right? And how long does it take? How long does it take for a stock to go up 100%? Well, in that time frame, whatever that answer is, let's say on average it's 1 year. Could you find 4 stocks that go up 20%? Because you'd make even just as much, a little bit more. Okay, could you find 8 stocks that go up 10%? Which is easier? 8 stocks that go up 10% to find, or 1 stock that goes up 100, or 4 stocks go up 20. 8 stocks that go up 10, you probably could find every single month, right? But can you capture them? Can you capture them? Well, you don't have to capture many. I just showed you. You only have to capture a very small number of them. So see, the real goal is not getting a big winner. That's not where the big secret is. The big secret is breaking even the rest of the time or losing very little. You see, that's the big secret. And then the upside thing comes really easy. I want to show you something else here. So page number 549. Some of you might remember when I was in the U.S. Investing Championship in 21. It was like the third quarter, October, and I tweeted. I said the power of compounding is amazing. Consider this: I'm currently up 227%. That's 23% away from 300%, right? Wrong. right? So now that I'm up 277%, actually, because of compounding, I only need a 6.2% gain to get to that 300. If I did return 23% from that point forward, I would have a return of 363.7%. Do the math. And I ended up being up, I forget what the final was, 343 or 348. That's that, and I broke the all-time record, which got broken after that by one of our students. I think the next year or last year. Um, so here's what I call the power factor. This is looking at compounding from kind of another angle, or understanding the advantages of it and how compounding takes the pressure off you, and the as you start getting the profits, just like before, I said we're going to build on profits, we're going to progressively expose. Even compounding affords you options of exposure. So you start with $100, 100,000, whatever it is. You make 30%, right? Okay, now you've got 130. Now, 30% on that is now not, it's not 30 anymore, right? Compounding, you're compounding 130 now. So now that same 30%, call it a stock, call it a return that year, whatever you want to call it, that same 30 is now worth 39. All right, it's 1.3 to 1. You now have a factor. You have a factor, a leverage factor. Now you now have $169, right? That same 30%. If I can find a stock that goes up 30%, or I have another year that goes up 30%, that 30% is now worth 50.7%. It's a 1.71 factor. And then one more time, that's now that 30% is now worth 65.9%. It's a 2.2 to 1 factor. Now you may say, well, that's obvious. That's compounding. Yes, but what it means is as you get a bigger return, you have to do less and less and less work. So like when I was here up 277% and somebody's up 100%, they got a hell of a lot more work to do than me to catch up to me. I can actually get more conservative because a 6.2% gain brings me up to 300%. See, a smaller gain, I'm leveraging now. I'm leveraging. This is another reason why people lose in the market, have bad returns, is because they start getting greedy when they're up and they press, and now that same factor works against you. Now you're also a factor on the downside. So as I start going up in my return, I actually get more conservative. I actually use progressive exposure once again. I talked about this with Arusha Paris of Bill of O'Neill, and he said he does the same thing where as stocks are working, gets really aggressive, and then if they keep working and things get really, really, really good, and I've achieved a really good return, I can actually afford to get a little less aggressive and start being more and more conservative and coming down to those smaller positions, and I'm still getting a lot of bang for my buck. I'm getting that original bang for my buck. Now, so again, this isn't strategic as much as it is you just to understand the power of the numbers, of the math, to understand the mathematics behind compounding, behind what's the real world. This is the real world, okay? But it's not your world. This is my world because I've understood how to create a world, my own universe, and operate within these walls that I've built. And now I've got a system and I'm taking advantage of all these factors that are complementary to each other. Let me show you something else with opportunity cost. So we did a study. This goes way back, and I think this study was done in the late 90s. My assistant at the time, we had a lot of discussion about this. We just started short-term trading in the 1993-94 was when we really could start trading. Um, Online, we had online access, commissions came down. 95 is where I really, and funny because up until 94, I didn't do that well. I had a couple good years, but then 94 to 2000, I made 35,000% in 5.5 years. That's what got me into Market Wizards. That was the returns he audited, and I averaged 220% a year. That's because all of a sudden I could trade. I could trade opportunity cost. So my assistant said, I want to quantify this. Like, should I be holding for a big, he's watching me making all this money and he's like, maybe I shouldn't be holding for a big move. Maybe it's foolish because while I'm waiting to hold for this big move, you're trading 27 stocks and compounding the shit out of it and making a ton of money. So he ran a study and we ran a study on the breakouts and took a look at what it took for these breakouts to get to certain levels of gain and how long, and within that time frame, what were you giving up in opportunity cost? What we found is the 5 to 15% range, that was your sweet spot. That's where you made a lot more money because of number one, you had way more opportunities. So you could compound it much more rapidly, right? And then you weren't, all this time wasn't going by. So you're making, remember I said in the beginning, why are we in stage two? Because stage two, we're gaining value and optimizing time. Stage 1 and 3, we're losing time. We may not be losing value, but we're losing time. And in stage 4, the worst stage, we're losing time and value. Worst thing, right? So why would we want to be in any other stage than stage 2? Well, I could give you that same question right now. Why the heck would I want to be holding for a 40 or 50% gain when I can make 6 times the amount of money trading 5 to 15% gains? These are facts. These are facts.
I was just going to say there's another golden slide, but like if you just to sum it up, it's another way to think about it is because everyone thinks, well, in order to make big money, I got to have big gains. Not true. This slide tells you you've got 5 to 7 times more opportunities in the smaller gains and turning and using compounding. Then you wind up with the best of both worlds in terms of bigger, more opportunities, which means more trading, more compounding, and smaller drawdowns. Who doesn't
Now,
want
and this is why I've made 700,000% on my money when Amazon went up 80,000% and Home Depot went up 70,000 and Cisco went up 100,000, and I was in them all. But I didn't make 80,000 or 100,000 or even 10,000% on any of them. I didn't hold any of those stocks for big moves, but I made 750,000% on my money over those same periods. Here's the thing. I want to make sure, and this is where Mark and Brandon got to understand this not even that long ago. I don't know how many years, maybe it's 5 years, whatever, 6, 7 years. But this is sort of almost kind of a new discovery as far as the light bulb going off from Mark and Brandon as well. I'm not trying to turn you into a short-term trader. That's not what I'm doing. All right. That's not, I'm saying short-term trade, don't long-term invest. Absolutely not. Those same buy points are where I'd be buying if I'm going to hold it for the next 10 years, 20 years, for a lifetime, or if I was going to scalp it for a quick 2-point move. I'm buying at that same spot. What we're saying is that every trade has to stand on its own feet, meaning that, and the short term, when we say you can finance your risk, okay, so it doesn't serve just that function. So let's say the stock goes up and it runs up 15%. Well, that's right in this zone, right? Great. We know that in itself is a great opportunity. So I sell half of that and I go for the bigger move on the other half. Well, I get the best of both worlds now. Now I can blend those. We blend those. So if we were to take these averages, that would just blend it. It would take it from the 1x to 6x, it would be a 3x or 3.5x, right? So, but I'm utilizing that short-term opportunity that has this great probability to leverage my longer-term probability. See, once again, I'm leveraging my efforts, and all these positive elements, all these positive mathematics are supportive of each other. And these are tools. These are tools that I use to help the other tool and get to where I need to get to. Now, I can get there. I can get there all on my own. I don't ever have to have a bigger gain than 10%. If I want to be a short-term trader, I'll still make big returns. I'll get there long-term investing too. I did that for the first 12 years of my career, wherever it was. I'll get there. It'll be a different way of getting there though. I'll go through bigger drawdowns. I'll have to get there it'll be a different path. Okay. So, but what I found is I can take all of this and I can use it together in a very in a homogenistic way where they help each other. And I can have the best of all worlds. Or hey, you could choose just to be a short-term trader, and that's where you've got tons of opportunity. But I could tell you right now, I know if it's going to take me a year to get 100% gain, and stocks are breaking out and giving me 8% gains on a weekly basis every month, I'd have to be a fool not to take that opportunity if I don't have the if I put ego aside and I just want to get to my goal. Well, it's staring me right in front. I'm standing in an acre of diamonds while I'm looking over here for another way. Doesn't make any sense. This is the conversation I had with myself a long time ago. A long time ago, I had this conversation in the early '90s, and that's where everything changed. Once I understood this, everything changed financially for me. My trading changed, everything changed. See, the key to consistent big returns is to risk small amounts of your principal, improve your worst case scenario. That's by moving your stop to break even, protecting your average gains, selling at the strength, financing risk, protecting that equity curve, maximizing compounding, scaling up based on traction, all that needs to happen around the math. You know the math, and you use all these techniques and tools to take advantage of the math, right? So awareness is first. Awareness is first. So what are we learning from mind-blowing math? What are the big lessons here? One, you do not have to be fully invested in the market all the time. Absolutely not. You don't ever have to be. All right. Now, but does that make sense? Like if I have 4 stocks that are setting up and breaking out, well, that means that if I do, I can make even more money because now I have even more opportunities. I'm the way of doing them all. Let me go back. Let's switch back here for a second. Doing this and going one trade into the next. Well, now I'm sacrificing these 4 opportunities that are all setting up at the same time. All that means is if I do it this way, could the return be bigger? Yes, it could be, but not if I do the same number of trades, the same trades. But what this could allow me, these 4 might set up in the time it takes for this one to go to that one. And now I can have more trades. This would just allow me to be able to do more trades in the time frame. It wouldn't change the return based on those trades, but it would allow me to get more trades done faster, which would just allow me to have more trades compressed into a time frame. So it doesn't mean that I don't go fully invested if the opportunities present themselves. So, but you don't have to be. Okay. 2, or actually 3, you don't have to have big gains for big returns. You don't need to ever have a big gain to get big returns.
Golden nugget.
Does that mean that we're not going to go for big gains? Of course not. Of course we'll go for big gains. As long as the stock's moving up, there's no violations. I judge it as whether I think the upside outweighs the downside. I'm sticking with the trade. Okay, you could stick with the trade, and if you again, once you're at a gain, you want to move the stop up, backstop your loss, and free roll it. Hold it forever if you want. That's fine. I'm not against holding stocks. I'm against holding losses. The compounding effect or the power effect, the more you make, the easier it is to make more. So you don't have to get overly aggressive. As you get profits and you start leveraging that, you could actually mathematically get less aggressive and achieve the same factor that you originally had and increment yourself up in a more of a linear fashion as opposed to exponential, because exponential works on the way down too. So don't lose sight of that. Sometimes we get greedy and we're the ice is melting beneath your feet because, as Paul Tudor Jones said, his biggest losses always came after his biggest win streaks. Every one of us can say that. Every one of us will experience that. So once I'm doing really well for a while and I've achieved a really great return, I actually get more conservative and I start progressively exposing down a bit because now I've got that power factor working for me. Saving
Another great hidden little golden nugget there. But yeah, if you do this long enough, it's sort of similarly like Mark was saying in terms of, look, yes, we know in terms of the math, but to his point, if you've compounded and you've had a really good run, you don't have to be as aggressive to get to your goal. And this is also then how you limit the size of that drawdown when you're in what we would call a hot streak.
Yeah. Saving bets. Okay, this is a term that they use in poker. Saving bets. What it means is all those times where you know you maybe shouldn't take a raise, but it's $5. I throw $5 in the pot. We'll see another card. I'll take that $50 raise. You know, I got a king 10. We'll see if I flop king 10 or flop a set of kings, whatever it is. You throw that few bucks, and over time, you're playing poker for 10, 15, 20 hours. You know what? Right there, there's your living. You could make a living just on saving bets alone. You can earn an income. The same thing. That's why they call it poker. Saving bets. The real secret is in saving bets. Big part of being a professional poker player and earning a living. So saving bets is. Where's the slide I had? I don't know where it is. Oh no. Okay. Saving bets is here. We'll go to this slide. Saving bets is all these days you're breaking even, right? That's the secret. Is not losing big. You don't have to make a lot. You don't in poker. You don't have to have a whole bunch of big pots. Your goal is to win a big pot every 1 or 2 hours. You win a decent, you drag a decent pot every now and then. You keep your losses minimal. You build your stack. You make a living playing poker. Same thing here. The key is saving the bets and not making big mistakes, and even just offsetting. You know, even if you're not making much money, as long as you're not losing much money. The key is in not losing. That's the key. When you put all these things, these factors together, especially now you put the probability of being in the uptrend, all the probabilities of being in the stocks breaking out from the VCPs, all that stuff. That's just that's just standard operating procedure. Now you put this behind that, and you do this properly, your whole life changes. Everything changes, and pretty quickly too. You'll be surprised. It'll change quickly for you, but are you going to be a master very quickly? No. Are you going to be having triple digit returns on a regular basis? Probably not. It's going to probably take a couple years before you're really even decent at this. But people go to college for 8 years to come out and make a six-figure income. You know, would this be worth a few years of hard work, even 4 or 5 years, if this could pay you for a lifetime and be life-changing? Yes. And this is another thing I learned early on. This is worth the investment. This is worth the investment. If you can learn this and learn to do this properly, it's life-changing financially, and it's life-changing in other ways too that you won't know until you do it. And we'll see what it does for you on another level. Let me see if there's anything I missed. There's a couple that I can go over later, not that important. This was a slide. This was someone's account. I'm even trying to remember where I got this, but I believe it was from Twitter. It was a guy who followed me and my strategy, and he showed me his performance. And what was interesting about it was, again, this was really the largest gains only accounted for 5%, 2% of the wins. Two of the trades accounted with an average gain of 17.4%, accounted for only 4% of total, 10% of the wins. It really just showed in real life exactly what I'm talking about, us about essentially breaking even, and really, only a couple gains gave this total return, 44% total return, average gain 9%, average loss 3.8, batting average 38. Really nice return. It all came from just a couple gains. That's it. It was just a couple, one, two, basically 3 trades out of 50 trades, because the rest of the trades didn't lose money. This is really, really an amazing discovery, of mine. This was an amazing discovery. I was blown away when I realized this. I was like, okay, I don't even have to necessarily limit my losses as much as I have to offset my losses. If I just break even, I mean, as long as maybe I'm losing 10% a trade, if I'm making 10%, if I can do a whole bunch of those trades and then just occasionally get lucky, I'm still going to make a good return. It's all about putting yourself in a position to get lucky, because you're going to get lucky. Every now and then you're going to get lucky. Okay. Pitch is going to come across the plate. You're going to be in the right place at the right time. You've got to put yourself in a position to be able to take advantage of that, or even by default, just take advantage of those lucky times by not ever having any real bad times. It's like Tiger Woods. Tiger Woods, he has bad rounds, but I'll go out there and shoot 4 8s in a round. He's going to have a lot less mistakes, very minimal major mistakes. So it's all about minimizing the major mistakes and keeping the mistakes as small as possible. And then everything else. This is where O'Neill says, and Livermore said, that the losses never take care of themselves. The profits take care of themselves. The losses never do. This is what that saying means. If you tend to the losses and you take care of the losses, the profits will be there and they will take care of themselves, but the losses don't. The risk doesn't. The risk needs a manager, and the risk has to be managed in real time. I don't know. Are we still going here? Am I still running here? Are we taking a break?
Yeah, I
Right
think
into mindset.
We're going right into mindset?
Yep. Yep.
Okay, so this is just going back to, it may seem, you may go, okay, got the secret now. Wow, this all makes sense. Holy cow, mind blowing. Yeah, got to go in there, keep my losses small. Easy said. Okay. Simple to understand, very hard to do. Very hard. Want to know why? Show you slide number 357. Right? You know you should sell, but you're afraid that it's going to go back up, and then it does. It goes back up. And it does it 10 times in a row. You get stopped out, and the stock turns around and goes back up. And then you're Monday morning quarterbacking. Right? So now you don't sell. Right? Stock goes down, and now you're like, I'm not doing that again. And now you get caught. Now the stock plummets, absolute wrong time. And now you take big losses. Now you're totally confused. You don't know what the hell to do, right? Because you broke your rules. You had no rules. You broke them. You're Monday morning quarterbacked. Okay, you buy here, right? You buy here. You're fearing that the stock will take off. You got a 20% gain, but you're saying, oh man, this is going to be a rocket ship. I've seen so many stocks take off. I sold them. So now you hold it. Now it comes all the way back down. Okay? You let it come all the way back down to break even. This is all driven by fear, by forecasting, by losing sight of what's important. What's important is that you make more on your winners than you lose on your losers, and you do it as many times as you need to do until you reach your goal. And they don't have to be big gains. Okay, they just have to be consistent, and the more you minimize your downside, the less you need on the upside. If I convince you of one thing, I hope it's that the smaller your losses, the easier the whole rest of the game becomes. The smaller your losses and the better that you can maintain that risk reward relationship, the more you can tolerate a low batting average, the more losing trades you can have, the more break even trades. As long as you're not losing, you can have lots and lots and lots of trades that don't do anything net, and you need far less trades to make your profit. Your compounding everything becomes easier. So
golden
why
nugget.
so why don't people do this, right? Well,
I just want to add to that last section too, Mark, is, like obviously, and everything's been building on top of each other to this point, but when he was talking about the reason we want to take these small losses is to keep yourself ready, and so that when opportunity presents itself, you're there. And rather than digging yourself out of a hole, or what winds up happening when you get into one of these periods is your emotions start playing on you and pressing you and causing you to do stupid things or things you know you shouldn't be doing and breaking rules and all the things we've been telling you not to do. Look, the key is finding or being not just convinced, but you realize then once you get out there, we didn't even talk about indexes and all the other things that are going to seduce you into doing things
Yeah.
you know you shouldn't be doing. The reality is we're not robots. And
That's absolutely right. That's precisely where I'm going. We're not robots. We're human beings with emotions, feelings, and we Monday morning quarterback. The result that going back to the example of going across the road, covering your eyes and making it to the other side, and then does the result justify the means? What if you did that 1,000 times? You gotta think in probabilities. It's hard for some people. I was really good at probabilities. If there's anything I was a natural at, for some reason, I was really good at odds and probabilities. Um, Card games, gambling. I was very interested in horse racing, anything that had to do with odds. I was interested from a very young age, and I thought when I was in school, I used to do math problems faster than my math teacher, and he'd say, "How'd you do that?" And then I'd show him, and he'd say, "Well, that's not right. Like that's not the right process, but you got to the answer." And I would have my own way of kind of compartmentalizing things and breaking them down. I just used a kind of a logical approach. So I was always good at that. I didn't it wasn't hard for me to think in probabilities. I actually enjoy thinking in probabilities. Some people don't like to think in probabilities. They're very linear. They want black and white answers. That's why we have people like, okay, well, if this does this and that does what, they give me a hypothetical. What should I do? Well, we can't tell you that. It's because it's not just black and white. There's a I have to see an example, and there's lots of caveats there that we have to look at and weigh against each other. So there's certain things are black and white, but there's a lot of gray areas here. And the biggest gray area is your emotions. This is where the mindset, and you really, if for those of you who don't have my mindset book, you really should get it because it's super important book even for trading and for anything in life. So here's another sort of question and answer. Um, you bought a stock, right? You bought a stock and you cut your loss, right? Whatever the percentage was, it was a $5,000 loss. Okay, none of us want to lose $5,000, obviously. But the next day, the stock opens up, it takes off, and for no reason, it blasts off, and it's up 25. You would have been up $25,000. How do you feel about that? How do you think you would feel about that? Would you feel good? No, or you probably wouldn't feel so great. You'd maybe think, oh, I wish I held it. But, you cut your loss, you stuck to your plan. You're certainly not feeling good about it, right? The next same situation, but the next day the stock plummets. It opens up, gaps down 25,000, $25,000 loss you had averted. How do you feel now? Now that loss feels like a bargain, right? Feels like a great loss. You only lost 5,000. Right? Nothing has changed. You have the same $5,000 loss, and you will have two completely different emotions from the same exact dollar loss. So what's different? What's different there? This is what you're going to face every single day. Every single day, you're going to be in this situation right here where you should sell, but you're going to be afraid it's going to turn up. And maybe not in the beginning, but after a bunch of them stop you out and turn around and go up, you're going to be thinking, "Am I a dummy? I'm going to be the dumbass that does this for the fifth, 16th time, and I watch these stocks double and triple, and then same thing here. You're gonna get caught. Eventually, you'll get caught because you've seen a lot of stocks go up. You don't sell them, and now stocks come down. These are all driven by emotions. All driven by emotions. So how do you remove these emotions? How do you control? How do you mitigate these emotions? Rules. Number one, rules. Process is how you apply the rules. An order of applying the rules, and then an absolute commitment to not only the rules but the style. Whatever approach that you're applying, you need to commit to that. A coach, whether it's me, whether it's someone else, you need to commit to that style, that coach, that mentor. Not you can't serve multiple masters. You can't serve multiple strategies. Find something that makes sense to you and then commit to it and then isolate. All the noise has got to go away. Get rid of the noise, turn anything that is opposed to that style, don't listen to it, right? Isolate yourself. Isolate yourself.
Yeah, I got to jump in here too because we talked about the COVID example, and I remember Mark telling the very first Master Trader program, slide 560 though, too, just for a quick reference. I don't think we had this slide, but it was the idea that, and I want everyone to know, this is a given. If you're going to be in this business, you're going to sell stocks that do both of these things all the time.
Yep.
And what Mark is trying to say is nothing has changed. So in coaching enough folks or whatever, if you are regularly going to get hung up on this kind of stuff, you're gonna struggle because
Yeah.
That's not what profitable trading is really about. But one of the things that helped me is this commitment and isolation, because everyone's going to tell you lots of other things of why. Well, you should have held it and this, that, and back to the whole thing about when you start thinking in terms of probability and data set or whatever, it brings the emotional temperature down. It's never going to remove it completely, but you can get less jumpy and more confident. But I can remember Mark saying, I can't remember if it was back when you were working on Wall Street. You said, I wasn't allowing anybody to influence anything I was doing. There was no news, there was no TV, there was no nothing. And I was brand new, and I go, wow, that seems a little harsh, a little
Seems
crazy.
extreme. Seems extreme.
Yeah, right. Extreme. It seems really extreme to me.
It was extreme. And
Well,
I didn't allow newspapers or articles or anything in my building on the floor. When I ran the hedge funds, nobody was allowed to have any outside research or news or anything that wasn't internally generated. Nothing.
And what that said to me was
Blackout. We had a blackout.
that's commitment in my mind. It's like I am going down, I'm going down tethered to my process, not what anybody else thinks. Well, fast forward then all these years later, it's 2020. I start seeing lots of setups and they start working, and where I'm coming full circle. Remember where preparedness meets opportunity, and you've learned all these things, and eventually you're going to find yourself, if you limit the drawdowns, in a really good situation. And I can remember telling Brandon, I don't care what anybody's saying. I don't want to hear anything about anything else going on outside the office right now. And we shut off everything, and I made more money in the next few months when people were saying the world was going to come to an end and people were riding all over the country and just political this and uncertainty that. Guess what? The market gave me the greatest opportunity I've ever had, because I adopted that whole isolation mentality of trust your eyes, not your ears, stick to the process, and stay committed.
I used to put everybody in a room and tell them, look, if you think that you need information or mentoring outside this room, outside what I am doing here and my leadership, then you don't belong here. You don't belong in my organization. Okay. So imagine when I was big with going to karate. I spent a lot of years in karate and was very dedicated. Can you imagine, or I couldn't imagine I go to my instructor uh, and tell him, yeah, I'm studying also down the street with another instructor. He'd have punched me in the face and kicked me out, and I'd never be allowed there again. And rightfully so. That doesn't happen. That's not tolerated. Now, maybe you want to do that, and you say, well, I want to go and and experience a bunch of things. Okay, fine, but you're not going to be a master at anything until you commit to that. You want to learn from a master, you need to commit to that teacher and to that style, more that style than anything, or you're just going to be a jack of all trades, jumping all over the place. This is about commitment, learning everything. You see how we went through 4 days here. I tell people ask me about other strategies. I tell them I don't know anything about these other strategies, but I know everything about mine. I know everything there is to know about mine. And maybe it doesn't mean I can't learn, but I'm a master at this. I know 99.9% of everything about this, and because I'm a master, I can teach myself and I can learn new things about it. But I know everything I need to know about my strategy because I made a lifelong commitment to it. And now it's being passed on where you don't even have to make a lifelong commitment to learn all this. You just got it all. You just got 43 years worth of learning all in a workbook that you can shorten your learning curve probably down to just a few years. Real quick, just a couple other things here. So, a lot of people they get a stock, it goes down, they hold it, they don't cut their loss. To me, it's like so illogical. Like, what does it matter if you buy a stock, it goes down 10 or 20%, and you sell it and you go into another stock, or that one comes back, like, except again, the ego. Like, I'll just buy another stock that looks better and look for that to go up the 8%. The stock comes off 8%, or in this case, 20%. What's the difference if I hold that stock and wait for it to come back or move into another stock? The difference is ego. That's all there is. It's just ego. And quite frankly, the one that is not acting well is the one less likely to make the 20% advance, because that's the one that's falling apart and under distribution and getting all the violations. So why not move into a stock that's acting better? So it just doesn't make any sense. But that's because we don't want to admit that we're wrong. That's why we spend a lot of time talking about losses. But this is what it's all about, and it's all about following a plan. Like, even if you have a bad plan, any plan is better than no plan. If you have you have to have a plan. And the discipline doesn't start with doing the right thing. The discipline starts with doing anything disciplined. Anything on a regular basis and regimented. SOP, standard operating procedure. I call it CAD, consistent application of discipline. So and then once you do that and you have a plan, you execute the plan, you can now analyze and see if it was a good plan, if it worked, and make adjustments, and then apply your discipline to that. Then finally, when you finally get a good plan, you'll have discipline built up. And believe me, once you get to the point where you've now developed a good plan and you've been disciplined with a bad plan, the discipline becomes way easier, because now things start working and discipline gets good to you. Discipline becomes great. So you want to avoid audibles. You make a plan. I'm going to sell this stock here. I'm going to do this. I'm going to do that. Execute it. Don't get in the trade and then get emotional and say, "Oh, I know I said that, but I'm going to do this now." And you start making decisions because you're emotional. Forget about the audibles. Just execute your plan. Stick with it. Get out of the trade. Analyze it. Do your post analysis. Formulate a new plan. Yeah, you want to make a change, now make a change, but do it orderly, under calmly, where you can analyze things, and then conduct that post analysis. Keep a journal, know the truth about your trading, look at those numbers, and the main thing is all of that leads to maintaining the integrity of your personal bell curve. And if you maintain, the better you maintain that left side, the easier it is, the less you need on the right side. It's that simple. But the key is maintaining that left side. And
I just want to add one point there
Yeah.
too, Mark, because especially for folks that are new, I think what he just talked about in terms of start with a simple plan, and or it's like that David Goggins. How about you make your bed in the morning before you go change the world?
yeah,
Let's
making
start
your bed is
like
the
like
ultimate starting point. And that's if you
But in trading, it's
yeah.
no different. And I find that, so many folks, they put it together this intricate plan, they can't even follow the first step. Start with
Yeah.
a simple plan that you can follow to the letter of the law 100%. And even
Yeah.
his point on audibles, anybody who played football or whatever, we had rules even when you first learn to call an audible, they let you run one small audible at the line. You don't get to change the play 20 times. And everybody wants it way too fast. And even for me, I'll sit there and go, Brandon, what was our original plan again? All right, we're sticking to that. Always default, always default to the simple plan you went with at first, because once you introduce too many variables, again, we're emotional. Don't think that even for professionals, like that, the market won't force you or press on your emotions into doing things you shouldn't be doing.
There's
Keep
a
it simple.
there's a book called Make Your Bed. It's by Admiral Bill McRaven. And that's the Goggins concept. Mine, I always said, and then we talked about this in the gala last year. I do box breathing. I do 5 or 10 minutes of box breathing each morning. I do box breathing at night before I go to bed. If you can't discipline yourself to box breathe, let's say you just say, so I'm going to commit. I want to see how many of you can commit to 1 year, 1 month, okay? But say 1 year of box breathing religiously every single morning. It's not going to change your life. If you took 5 minutes out of your day in the morning before you got out of bed, I don't care what your life is, the president of the United States, anybody can do this. All right. It's not going to change your life. So you make it a priority and you do it every single day for 1 year. I would be willing to bet that 90% or more of you can't do that. And I don't say can't, you won't. You will not do it. You will not be willing to make even that small commitment to something that is that regular and that certain. So if you can't do that, you probably can't cut your losses religiously. All right. So that's why Make Your Bed is so powerful. Bill McRaven is the book, Make Your Bed. And then, of course, there's David Goggins' book. Great books. That's the concept, though. That's why in the military, that's why your shoes are shined, your belt buckles shine. That's why your bed's made. This is all about discipline, regimen, standard operating procedure, becoming absolutely committed. There is no other, all other avenues are cut off. There is no other alternative but this. This is the
This is also though why, Mark, I think you talked about you talked about the military, sports, music. Like a lot of these things are good backdrops for trading because they reinforce that discipline.
Okay, there's some slides in here that I'm not going to go over. 8 keys to super performance. This is in my. I would recommend that you read this in the back of my second book, Think and Trade Like a Champion. Here's some. These are some trading rules and tips why people fail, the traders fail. But I want to go over this one right here real quick. Before every trade that you make, you should ask yourself 2 questions. First of all, whenever you're about to make a buy decision, ask yourself, if I could make only 10 trades per year, if I made 10 trades today, I couldn't make another trade for a year. If I made 10 trades this month, I couldn't make another trade for a year. If I made 1 trade a month in 10 months, I couldn't make another trade for 2 more months. If I could only make 10 trades per year, would this be one of them? And what that does is that focuses you on the really best choice setups, the aces, and trust me, you're going to be wrong a lot. You're going to say yes, you're going to make a trade, you're going to go back and post analysis, go, why the heck would I ever have picked that as one of my 10 trades? And that's what's going to teach you. That's what's going to teach you. And when you get to the point where you can say yes and then look back and post analysis and say, absolutely, that was a absolute choice play. Even though it didn't work out, I was dealt aces and I played those aces. You'll know you got there. The question is that when next time you're about to make a sell decision, whether it's a loss or it's a gain, ask yourself, how is this going to look on my spreadsheet? You're at a loss. It's at 6%, 5%, 8%, ballooning, 12, 15%. How is this going to look on my spreadsheet? If it's a 15% loss, I know it's going to be way the heck over here on the left side, sticking out like a sore thumb, this aberration that wasn't supposed to be allowed to get through the wall, right? If it's on the right side and I've got a 50% gain and my average gain is 12, I'm way above that. That's a gift. That's an aberration, right? I got to protect that. I want to increase my average gain. See, we want that spreadsheet to be in your brain. I want that spreadsheet to be in your mind and always making its way back into your trading and thinking in terms, because now you're thinking in terms of mathematics. You're not thinking in terms of emotions and what the TV says that the target is of the damn stock because JP Morgan set a target. Some nonsense, right? We're going to trade by the math and make good risk reward decisions and optimize everything that we're doing and get in the habit of making every choice a quality choice. Every move you make is a quality move. You don't make a single trade, a single decision unless it is that's the goal. The goal when I was playing lots of poker, my goal in poker had nothing to do with winning, with anything other than I wanted every decision to be a perfect decision. I got dealt a hand, I knew the math. I know I can't make all perfect decisions, but my goal was to make every decision a quality choice, a good risk reward decision. There's a good reason behind it. I'm not just throwing money in because I'm on tilt and I'm pissed off. There's a reason, mathematical reason, and a reason behind everything. And the goal was a quality choice, a choice on every play that I made. And you know what? I stopped playing regular poker, I think in 2006. I'd have to ask my wife because she got tired of sitting behind me for 25 hours a night. Um, but since then, I still have cash that I made from poker that I haven't spent. I made so much money playing poker when I was playing poker. By those rules, no different than this too. I went to the best. I went to Eric Seidel. I went to TJ Cloutier. Won more tournaments than practically anybody. I went to the best in the business, and I paid him. I told him, "What do you? I want to take lessons." TJ Cloutier was sitting next to me in a tournament one time. I was in a WPT. I said, "TJ, do you teach? Do you do any mentoring or teaching?" He goes, "Nope." Just like that, I went, "I'll give you $2,000 an hour." He goes, "When do you want to start?" I said, "Right now." He goes, "Let's go." We jumped up. Next thing you know, I'm sitting with TJ Cloutier and he's teaching me, and it wasn't much different than this. He's screaming at me, telling me about draws and playing hands and of hope and taking heat on trap hands. Um, a lot of similar rules, being able to muck hands and not um, every decision being a quality decision, every decision being a quality decision. I remember saying to him, wow, this is like all the stuff that's in your book. And he looked at me, and I give the same answer now to everybody who says it to me, because people say, "Oh, this is everything that's in your book." I was, "Well, what did you expect? I wrote the book. I mean, yeah, of course it's in my book. What do you think? I was going to lie to you here, or I'm lying in my book?" Yes, that this is it. There isn't anything more. There isn't anything more. So let me see if there's anything else. I know I skipped a couple charts, but a couple slides, but we're going to go over stuff anyway on tomorrow. We still have a whole nother day, so this isn't the end by any means. And we can go back and look at slides, and there are some that I do cover tomorrow that I didn't cover today. But as far as the curriculum's concerned, that this is the end. So this is the end of the curriculum. You made it through it. It's a lot. It's a lot to stay. And I see the participants here, and it's barely varied at all. Everybody has stayed on this call every hour for the 4 days, and very few people have left for even a second. So you all stayed attentive, and it's a lot. It's a lot. This is a big commitment. You're already in an elite group. You're in a very elite group by even taking this step. So give yourself a hand for that, and I appreciate your faith in us as instructors. We we just want the best for you. Tomorrow, I know the market when it went into complete like Suckville this last week, so I don't know what we're gonna find to trade. Bob usually
That's a
finds
technical term.
Suckville. Bob usually finds intraday trades when we can't find coming out of the daily. So he's pretty good at finding. He was did a lot of day trading in his day, and he'll find a lot of day trades. We might, because we can apply the same tactics to day trading. We might have to do that to trade something. But either way, it's going to be great. We'll watch the market. I'll go through screening and go through the process of what I do, the routine. We'll show you the platform and the post analysis tool, analytics, all that. Answer questions all day long. We'll be just all day long popping in and out, with questions. I don't know, anything else, Bob, to prep for tomorrow, or anything that you need to go over?
Nope, really, that's it. Let your minds relax and rest. You can send questions through the night to workshop@minervini.com. Appreciate all the comments and thank yous that I'm seeing posted here. It is our pleasure to be able to do this with you for the 16th year now. And 8:30 tomorrow morning, um, New York time is when we'll get started. We'll open the room 30 minutes beforehand, and that's when we can go through not only those questions, but also we'll have time for ticker symbols and things of that nature. But there's a whole nother day, like Mark is saying, so plenty more to go. And with that, Mark and Mark, Richie, helpful as well as always.
Yeah.
and
Yeah.
we will definitely have, more knowledge, more education, and more comments tomorrow with that wrap up. But otherwise, a great day 4 of the 2025 Master Trader Program with Mark Minervini. Again, I know it's a lot of information, particularly this day, but it is the most fun. So let your thoughts absorb what you've learned and send in any questions you have. We'll make sure we get as many through as many of them as we can.
And my work is not over. I have to do our weekend video now, and I got
Yeah,
to do it quickly because Bob
yeah,
needs to, I guess,
yeah,
the bandwidth and the promulgation of the videos and stuff. So I gotta get off here and get to work myself. So
yeah.
my day has not ended. But we'll see you. I'll see you tomorrow, and Mark Ritchie, and we'll see everybody tomorrow. We'll have
Excellent.
Brandon could be on too if he's available. We'll have Brandon, maybe even Mike Lamont. We'll have the whole team on tomorrow.
Yeah. And tonight's presentation, second presentation, I should say, the encore of today's session will start at 6 p.m. Eastern, New York time. And I will see you back in just a couple hours.
Okay, see you guys.
Thanks.
See you tomorrow. Bye bye.